With the prospects of higher US rates and a continuation of the failure of European authorities to drive either growth or inflation, commentators have been eyeing parity between the US dollar and the euro for much of 2016. We're looking now at those fundamentals and overlaying technical analysis on the charts to see how things look as the currency markets go into 2017. Ron William joins us now from RWA Advisory. Ron, welcome.
Hi there, holiday greetings.
Yes, as we go into the holiday period, and of course, which is traditionally quite quiet, we've had some interesting developments recently, of course, with the much heralded rise in US interest rates. And as I said at the top, the Eurozone continues to fail to drive itself out of this mire of poor economic growth and inflation. From a currency market point of view, what's your commentary?
Well, it's very much interesting and compelling day by day, and the opening chart that we have shows that history can repeat but not necessarily rhyme. Since the last Fed hike of a quarter point that we saw last Wednesday, the same move that happened in 2015 December had a much lackluster price move on the dollar and other currencies. So we can see there the dollar index had a very mild move of about 0.02%. That's the blue bar on the histogram. Whereas the day of the last week's Fed hike of the same amount was a much more significant 1.1% end of day move since then. Now, of course, the move, the hike in general was positive for the dollar, negative for the bond market and for the equity market on the day. But more than that, the reason why this time was different than the other is because the hawkish stance that the Fed had maintained was that much more aggressive into 2017. And also, this was against the backdrop of a more supportive technical and political backdrop with the Trump-elect victory.
I'm interested as well in your second chart, just to couple up with that, because you've overlaid the graphic representation on this. And if we look at these three lines that you've got on here, explain what's going on, because clearly you've got that hawkish forecast for 2017 on the right-hand side of the chart.
Well, the industry term for the orange line is the Fed dot forecasting metrics, which the Fed basically has been producing since 2012, just to give an indication of what they actually forecast Fed fund target rates are likely to be. And we can see here that the orange line, which is the Fed actually telling us what they might do, versus
the dot plot, isn't it?
Which is the dot plot. With the black line, that's the market's prediction. Both pretty much in line with 2 years of dovish forecasts. So we've been very conditioned for dovish surprises over that period. And so any mild shift in their stance into a hawkish stance, this is what we saw last week, really did have the caliber to shake the market a little bit. And that's what we saw. And that's the reversal there that we're starting to see now at the bottom of the chart. Now, all of this is overlaid with the dollar index chart just to show the correlation of the two. That's the green line, and we can see both price moves on the dollar index last week versus the year before. So I've just circled it there. The current new high breakout, which is at 13-year highs that we're seeing on the dollar index, versus the peak that we saw in December of last year. And of course, this time is different because the dollar index is maintaining its upside. It's not just a short-lived peak process. But the other thing is looking at speculative flows in both periods. Institutional capital flows into the dollar is much more stronger and suggesting further confidence in the dollar, not just now, but certainly into the new year ahead. Whereas if compared to last year, people were scaling back their bets into the dollar during the Fed meeting and thereafter in December of last year. So a complete difference in terms of price and capital flows on the dollar. And of course, the hawkish stance is that much more aggressive into the new year.
Well, let's get some more detail now on that price action that we've seen. And I think the next chart brings us on to the sideways trade movement that we've seen. And we got this major breakout. And just before we went to air, we were talking about this chart in the context of Elliott wave, those people that understand that particular technical analysis tool or observation. You've drawn it quite neatly on here.
Well, wave analysis is a way of understanding the price sentiment and psychology of a market, and particularly when there's an impulsive move in a strong trend. And that's what we're seeing here in this very strong uptrend that we've seen for the best part of many years, since 2011, when we bottomed in the dollar on the dollar index. So for those who are wondering, will the dollar continue up, or is this likely to be a peak out of some sort, it really does help to look at the technicals at the moment in terms of the long-term structural moves. And what it shows is, one, we have broken out of a 2-year trading range, which is likely to project at minimum the price objective of the height of that range. So that's one thing. So
that's a green arrow there, which is replicated on the right-hand side. Yep.
Yes, so it's the green arrow there, which I've then replicated on the upside. I shrunk the arrow a little bit just to fit the chart, but of course it will at least achieve that target, if not higher. The other thing is, what the wave perspective suggests is that this is the 5th wave, so this is likely to be the sharpest upswing of this 5-swing move, which is very bullish and impulsive. And that's usually a wave equality of what we deem as the first initial impulsive move of wave 1. That's an additional upside target that we could see on the dollar. And in terms of external factors adding to the technicals, again, it's the rates, it's the hawkish stance that we're now seeing in the Fed, but also potential Trumponomic positive sentiment that we're starting to see, where the markets are lying a lot of maybe confidence with the new president-elect in his new presidency next year, and potentially further tail risk into 2017, which might lend itself to a safe haven flow argument back into the dollar. So we might see a nice mix of upside scope for the dollar in addition to the technicals.
And your next chart moves into that quite neatly, because you've got the euro against the dollar, the German 2-year yield against the Treasury 2-year yield spread, which gives us further indication as to how these two regions are separating.
Well, yes, when we're looking for trade ideas, it really is important to look across markets, especially in currency world, to see the other side of the coin. And we can see that there is a great divergence at play here in terms of interest rates policy between the US and the rest of the world, but particularly the US and the EU. And this chart in the green line actually shows the spread, the difference between the US 2-year yield, government yield, versus German Bund government yield on the 2-year side. And what it shows is both are steepening, but the US is ahead of the curve in terms of its on the short end, where the Fed is actually now reactivated a hawkish stance, whereas of course the ECB is doing the opposite with their quantitative easing, which brings to an end, from a technical perspective, a long-term structural bear market in yields, bull market in bonds, which has been running for the best part of 30+ years. So that's suggesting further rise in rates, coupled with the new hawkish stance of the Fed. Now, looking at the chart, I've just highlighted there for those who are interested from the fixed income perspective, this divergence is marked by what fixed income practitioners call a bear steepener in the US, so we have rising short and long end yields with a sharper increase on the long side, and on the EU side a bull steepener, which is falling short end, so that's the ECB QE program marked with faster which is falling faster than rising long end yields. So we do see a rise in long end yields on both sides, but it's the central bank policy which is diverging there. And on the chart itself, the net effect is seeing that this spread differential, which is at a historic widening, is actually leading euro-dollar down. So we can see the blue line leading the orange line down, orange line being euro-dollar.
Yeah, now this takes us to the final chart, which crowns the whole point of getting together to discuss this, is ultimately the call for parity. And as I said, we've been flirting with this idea most of the year. We've spoken about it before. Most of the foreign exchange currency traders I've been talking to have said it could well happen. We're not quite there yet, but I certainly seem, if we bring up the last chart, it's impending.
Well, yes, as we discussed in our last interview, euro parity, euro-dollar parity is a clear and present reality, and certainly now more than the last time we spoke, because we are currently in a new low breakout territory, levels last seen since the early 2000s, and that's the break that we spoke about before, below 104.62, which is roughly where we're trading out at the moment. If euro-dollar maintains that on a weekly basis, and certainly into the end of the year, that will suggest further extended downside downside, certainly into parity at the very least, and I have further downside targets in and around 98.70, 98.50, but certainly below parity. Keep in mind also the both sides for the trade here. This is a dollar positive story, and it's also a euro negative story. And on the euro side, we still have lots of geometric political risk into the new year with the bout of European elections in France, Germany, and many other destinations, which is likely to continue with this populist wave of surprise that we've been seeing so far.
Teeing us up for a very interesting 2017.
Yes,
yeah.
Indeed.
Ron, thanks so much indeed. It's great to catch up with you again. That's Ron William from RWA Advisory, looking out at the prospects for parity in early 2017 for euro dollar.